Welcome to the Wealth Steading Podcast. This is episode 474. Today's June 13th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, in today's episode, I'm going to talk through what I think about when I'm deciding to exit a trade. In today's example, I'm going to talk specifically about a trade that I made this week when I reduced my position in utility stocks. But what I have to say in general is the thought process that I would go through when I'm deciding to buy, sell, or hold a stock. Okay, before I get into all that, just quickly want to mention how resilient this stock market continues to be. It surprises even myself. And I'm about as cynically optimistic as you can get, but look what's going on. Israel is bombing nuclear facilities in Iran. There's protests, violent protests in the streets of the United States. We have no further resolution or really any progress on tariffs or the international trade situation, and it continues to be woefully evident that the United States has major issues when it comes to securing critical items in its supply chain. You know, right now the big thing in the news is the rare earth magnets that the U.S. can't supply for itself, but we saw these other things emerge during the pandemic. Not enough medical supplies are made in the United States, pharmaceuticals, and for all the talk and the efforts that's gone into rebuilding our manufacturing base, the holes are so immense that, it's going to take time and effort, and we just can't quickly resolve these issues that have taken 30 or more years to develop. But hey, here's the bottom line on the resilient market. Again, with all the global turmoil, and specifically riots in the streets in the United States, bombs going off on nuclear facilities in Iran, and where's the stock market? As I record this, S&P 500 is still above 6,000, and it's holding firmly above its short-term moving average. I mean, it's totally amazing. But I will get into the fact that I do think there's going to be a sell-off later this summer, and that's part of the reason why I did choose to sell my utility stocks, but that's only a small reason. Okay, if you've been listening to the podcast for a long time, you know that I've had an extreme overweight position in utility companies. And these utilities that I've invested in, although not exclusively, they are primarily focused on utilities that generate electricity. That's been my overall focus. I started buying into this position March of 2024. I added to it throughout last year. And because those stocks have performed so well over the last 12 or more months, I find myself with wanting to cut back and take profits. Number one, because the positions have grown so much. And then also, as you probably have heard me say, utilities have been a really good performing sector in 2025. They held up extremely well, much better than the general market during the initial part of the tariff sell-off in March and April and May. And it looked like they potentially were going to break out to an all-time record high. I was holding on to those positions just in case they did because I would have sold them on the breakout. But that breakout looks like it's failed. And so because I do have that concentrated position, and because I do think that utilities, at least maybe for the short term, are likely to maybe not underperform, but at least market perform, that I want to lock in my profits and have that money available for better growth opportunities. But this is a classic example of where I'm not selling everything. So when it comes to thinking about, do you buy, hold, or sell? Well, in this case, I'm selling, but I'm also holding. Because even though I'm making the sale in these utility stocks, I still am over-concentrated. Now, nowhere near where I was before, but I've taken that, 30% plus concentration in my portfolio down to maybe, 6 or 7%. And 6 or 7% may not sound like much, but the utilities actually make up an extremely small sector of the S&P 500, something on the order of 2 or 3%. So if I'm holding 6 or 7, then I'm, more than twice as much concentrated in that sector as opposed if I was just equal weighting it into the S&P 500. Hey, let me step back here for a second as well. I posted on Monday of this week about my transaction. You can go to investablewealth.com under the blogs and alerts section, And you can see the stocks that I sold outright. There were 2 or 3 that I totally got rid of. There were another 10 or so that I made the major reduction in, but I'm still holding. And then, not really listed there, but there's another probably couple utilities that I didn't make any change to at all. But that'll at least give you a feel for what I've sold and what I'm holding. And specifically, I did put in that post a chart of the utility index, and that one I used the ETF XLU. So you could just get a general feel, because I don't have a composite to show you of my 15 to 20 or so utility stocks that I own, but just to show you a snapshot of how the utility sector has performed over the last year and how it's maybe peaked out with its multiple tops here recently. I put in that chart of the XLU. So check that out. And then also, if you do subscribe to the free blogs and alert notification, you should have gotten an email on Monday telling you that that had been posted. I know a lot of you didn't receive it for some reason. The Microsoft servers flagged it as spam, and there was absolutely nothing spammy about that post. But Bill Gates hates me, and so if you use something like Outlook or Hotmail or one of those Microsoft servers, you likely didn't get that post. It's always a good idea to check your spam folder. Make sure you have anything coming from investablewealth.com or wealthsteading.com white flag so it gets through your spam folders. And then always keep in mind, everything is archived at Investable Wealth under that section of blogs and alert and update tabs. So you can scroll through there and see more than a decade of posts that I've put out throughout the years. And by the way, I will be changing the format of that notification email to get around some of these holdups with spam filters. So you'll see that on the next blog post that I put out. Yeah, but back to the rationale. So if I think these utility stocks have maybe topped out for the short term, why didn't I just sell everything? Well, number one, I can't predict the future, right? So maybe they will go on to put in all-time record highs. And number two, they still are playing a key role in one of those niche areas of my overall portfolio thesis, which is focusing on industrial technology stocks. In fact, they're at the core of it. I mean, just about everything I'm invested in, especially on the industrial side, well, I guess most of the technology stuff for that matter too, all relies on electrification. And we're at a point now where, for the first time in more than a generation, we're not only seeing large demands in future projections of the needs for electricity, but we're seeing estimates raised in some cases 2 or 3 times, and we're seeing the big hyperscalers where they're willing to pay 3 or 4 times the going rate to ensure that they have an electrical supply for the next, decade or more. So we're in a very unique transitional point when it comes to the U.S. economy and its need for electrification. So I still want to own utility stocks, not only for that growth aspect, but also, and this is really, half the original reason why I bought it last year, was the protection on the downside. When the market did fall apart after Liberation Day or even before Liberation Day, the utility sector only dropped about half as much as the overall S&P 500, and much less than the growth stocks associated with the industrial tech side of things. So, this is one of the rare cases where something like utilities is not only providing upside opportunity with growth, but also protection on the downside. And also keep in mind, these utility stocks, most of them, pay above average dividends. So again, if you look at that chart of XLU, the utility index, the total return because of the dividend is even higher than what you'd see on that chart. In the case of the stocks that I own over the last year, I'd say on average, aggregately, they paid over 4% dividend. And so if you end up with just say a 20% overall capital gain, and then you've had that generous dividend, now your total return for the year is like 24%. That's not too shabby, especially considering the downside protection that utilities offer. And speaking of downside protection, with the markets very close to all-time record highs and this major V-shaped recovery that we've gone through, we're coming into the dog days of summer. Generally, we do get higher volatility during this summer because there's overall less liquidity, meaning, More people go on vacation or they don't pay attention to their stock portfolios, and so you have less buying or selling going on. And if any bad news comes out with that lower liquidity, it generally means that the market would drop more than it normally would on bad news. And could there be bad news coming out this summer? Well, absolutely. Again, we've got bombs dropping in the Middle East. We've got rioting in the U.S. We have the Ukraine war going on for an unbelievable 3.5 years at this point, again with no resolution in sight. And something else to keep in mind over the summer months is that we're going into the second quarter earnings reports, and you're likely to hear the media make a big deal about how there's been a big reduction in corporate profits. And while this is true, and while, in fact, there will likely be something like 70%, again, 70%, 70% decline in corporate profits for second quarter. And the media will pump that up, they'll scare everybody, they'll likely get you to go out and sell your portfolio because we got this profit recession. But you know what? I don't care. I don't care because what they're not telling you is that first quarter profits have come in astronomically high, like over 13%. Are you hearing that touted anywhere? Remember how we've heard endlessly for months that consumers weren't purchasing, prices were going up, inflation's going to be out of control, the Federal Reserve's going to have to raise interest rates, and there's going to be this big sell-off, and companies are going to have to absorb all the tariffs, and all the fear and gloom and doom in early April drove the stock market down like 20%. And yet, looking back on that very quarter that everybody was so worried about, corporate profits clocked in at over 13%, and this is at a time when, at one point, the Federal Reserve of Atlanta was calling for a 3% decline in overall GDP. Nonsense, okay? You're going to probably hear that stuff promulgated again all around these declining corporate profits. I'm not worried about it. I don't think you should be either. If second quarter profits do come out being, say 4%, while that might be a 70% decline from where they were, just think about it. Average the two together. That comes out to about 8.5% overall in the first half of the year. An annualized rate, right? That's not such shabby growth on profits. So I'm anticipating that bad news, but I'm not worrying about it. In fact, I would see it as a buying opportunity. And so any of this bad news can get triggered over the summer when there's lower liquidity. We could see a drop in the market. In fact, if I were to predict the future, I would assume that, we're going to see a 5 to 10% drop sometime in these next 6 weeks or so. And that doesn't mean I'm going to lose sleep at night and go to cash with my whole portfolio right now, because that is just a bump in the road. And while it's likely, there's nothing written in stone about it. Again, look at today, all these global turmoil, and the S&P 500 is still trading above 6,000. So what I want to do is, I have somewhere probably in the order of maybe 20% of my portfolio in cash because of all this locking in my long-term gains on the utility sector. For now, I'm going to keep that in a money market fund. And then as opportunities come about, right, could be 1 or 2 stocks over a day or a week process where I see an opportunity, I'm going to buy them. Or, if we do get a 5 or 10% pullback, something where the S&P 500 drops back down to its 200-day moving average, which is around 5,800, or if there's a real scare, the 50-day moving average is even farther below that. It's right around 5,600, which would give you in that range of, 5% plus drop. Well, I would probably buy that dip at the 50-day moving average and just lump sum everything in that day or over a period of 2 or 3 days. The point is, I'm going to remain flexible, but the majority of my portfolio is still in the market because I do believe, overall, of above average growth, long term, in industrial and technology-focused stocks, particularly in North America, is going to pan out. But again, I don't know, I can't predict the future, and I'm not worried about it one way or the other. I remain cynically optimistic. And so, hey, until next time, this is John Pugliano wishing you the very best returns.